Hi everybody, welcome to another update on the stock screener. Today we're going to continue talking about SOMA Gold, and we're going to talk about a discounted cash flow model, as some people have expressed interest in that calculation. So how are we going to do this? I calculate the NPV, net present value, based on the net income. Okay. So we first need to calculate the net income for every year. And based on that, we can calculate the net present value. We use a 10% discount rate. That's a very good measure. And we are going to make some assumptions for the coming years. So first of all-in sustaining cost, we know from the presentation that this number is 1,100 in 2022. And this includes sustaining capital, the operating costs, exploration, and SG&A. So that's what's in the AISC. This is going to drop by $200 to $900 for this year. So that's our assumption, and this is going to drop even more next year. What happens then, we don't know, but let's assume that it stays at 800 and then it goes back up because the high grade ore is going to be lower grades at some point, and then some inflation, then we add AIC to 1,500 eventually. But yeah, that's the AISC. And then we have the production. We know that it was 23,000 ounces last year. This year will be 36,000. Next year, 45. And then we go to assuming 50,000. Then they will upgrade the mill, double the capacity to 70,000, and some more growth to 100,000. Okay. Then we have the gold price. We expect that the gold price will rise. So 2,000 this year, next year 2,200, 400, 500 to 3,000. I don't think that gold will go down. Then we have the exchange rate, 1.3. Capex was 9 million, I think, sustaining, and there was 10 million for growth capex. So I think this is 9 million. This year will be around 6 million, but I added some more just to be safe, and then add some more due to inflation. Interest expense is 4 million also for this year, and next year we will pay off some of the debt, so could be 2 million with refinancing, and I expect that it will all be paid off by 2025, so no interest expense. Tax rate we keep at 35%, and then we can calculate, for example, the revenue. Revenue is gold price times production with the exchange rate to make it in CAD. The cost is production times AISC and with exchange rate to make it to CAD. Net income is the revenue, right, minus the cost. So this minus this times the tax rate, 1 minus the tax rate. This is just the exchange rate, and we subtract capex and interest. So that will give us the net income. If you see something wrong with the formula, tell me. But this is almost the net income that we got this year. It was 200,000. 600,000 here. But look at this. When we do the calculation here for this year, we get around 20 million net income. Next year, 40 million net income based on these assumptions. Then 50, 70, 100 million net income. So assuming that they have the resource and they can expand, we are going to see eventually 70 million, 100 million net income. Current market cap is only 70 million. So I think there is a lot of upside coming in the next years. So how do we calculate NPV now? There is this formula. We take the net income, divide by 1 plus the discount rate to the time. So this is 1, and this is 2, 3, 4, and so on. So these are the discounted cash flows, and then we add them all up to get the NPV. So that's the NPV is the sum of all these cash flows. And then you get this nice chart, which tells us how the cash flow will accumulate. So we are in 2023, there's only 20 million coming in, but next year we grow to 50 million, this plus this, and so on. So the cash flow, the NPV is going to grow up to above 100, 150 million at least. Current market cap is only 70 million. So if you hold this company, I'm sure that the stock price will rise at least a double to a triple if you just hold it. Of course, you need to be bullish on gold. But this is the trajectory of the NPV. Right? So that was the NPV calculation. Now we can play around, of course. Let's play around with the gold price. Let's say the gold price is going to drop instead of go up. Then you can see that the chart starts dropping. 1700, 1600, 1500. So that's not good. If the gold price goes down to 1500, then the cash flow is not going to increase anymore. It will probably stay at below 100 million. And that's not good. And there's no upside anymore in Soma Gold if the gold price drops. Of course, I don't expect that to happen. So let's go back. Next up, we could have tax rates going up. That's very possible. Let's say next year, Colombia increases taxes to 40%, 45%, 50%, and then economy is doing very badly, 60%. Let's keep it at 60% tax rate, which is very high. Then you can see that the NPV drops to 200 million, but that's still very good. There's still upside. In a few years, you could see a double to a triple, even when the tax rate increases. So that's good. So it's the gold price that's most important. What can change as well? Yeah, costs could change. Let's say it's not going to be 900, but 1000, then 900. Let's add 100 to all the costs. then we get the following. Yeah, maybe the grades were not that good or labor costs go up, then AISC could be higher than expected. Even then, we have NPV of 300 million. So plenty of upsides if you hold it. Double in a few years, triple in 2 to 3 years probably. So there's a lot of upside still, even if the AISC is higher than expected. So there you have it. This is how you calculate the NPV. And I'll see you in the next video. Bye.